Hello, Warriors. How you doing, AJ? Rand, how are you? Mike Delfino, Paul Penman, Michael Weissman, how are you? Shahab, Sinatra, team. Everyone's doing okay?
Good morning, Coach.
Hey, guys. How are you guys doing?
All good, mate. You?
All right. So I think I just had the charts up. Oh, here we go. All right. So here's the theme. Don't bank on the banks. There's Citi. I showed it a few weeks ago. Said it wasn't just regionals. And that shows up pretty good in Citi. You know, if this is going to be a breakdown here, measures 31 if I go the weeklies. But I just also want to show that, you know, the whole money center bank ETF looks like it was breaking down yesterday. And of course, the regionals even look a little bit worse. There you go. They're going to new lows. I have a speed line all the way down at about 27. So for those that thought the bank problems were resolved and we had a little recovery here, there's more downgrades. And, you know, to me, I was always taught that the banks are the central nervous system of the whole economy and the market. So if there's a problem with the banks, it's hard for the market to make a lot of progress with a bear market happening in financials. So just wanted to show you guys that. And this is pretty important here. So weak rally threatening a breakdown in cable today. That's going to, you know, open the door for at least 24 to 22.
Yeah, Dale, there's some the European PMIs, both the Eurozone and the UK PMIs came out overnight, and the services PMIs slipped into contraction territory. Okay. And I think that's that I'm sure Ryan has a lot to say about the PMIs overnight and what happened there.
Okay, yeah, and so even with a strong dollar, yen's coming off. You know, that's a little different action than we've had. Let me just, so go ahead, Ryan. Tell us about the PMIs.
Yeah, I was going to say, just that cable chart, we're bang on the start of some big levels here.
Yeah.
It's prior lows. It's also the, there's two fibs here, the 50 fib. Let me go and check on my chart. Give me 1 second.
Off the daily.
It's the 50 fib of, sorry, it's the 61.8 fib of the May move, the May leg.
Okay, got it.
And it's also the 38.2 of the wider March leg, right, in that 28-30 area, and it's those prior lows. So big levels around about the 126 area. But yeah, the PMIs were very dodgy, particularly from Germany. That came out really bad. Services also moving heavily into contraction. That sunk euro sterling through 85 for a moment, and then the UK numbers sent it back the other way. So
yeah, look at that reversal day we have going there.
Yeah.
So you know, that looks pretty good.
Yeah, I don't think we're out the woods yet in that 85 level.
You don't?
No, I don't think so.
Good. Okay.
But you know, the level's holding strong enough for now. Plenty
looks like a stop hunt to me, brother.
Yeah, well, it's a bit of a zone down to about 80. If you go back a bit further, it's another one of those long-term traffic zones.
I think that's what Stelios was looking for. 80 even.
Yeah, 82s, I think.
Okay, 82s.
Something like that.
All
yeah,
right.
Close enough. But yeah, if you stick a line in that 85, you can see it goes all the way back there throughout the years.
Okay.
Big old zone, but you know, it's holding for now, and like we say, a level is a level until it's not.
So, yeah, I think it's you know, worth a shot the way it's tested it 3 times, took out the stops and reverse, unlike the pound, which has tested this level 3 times and is now reversing, which is on the verge of a breakdown. So, you know, I don't think cable's going to hold this support.
No, but that'll be a strong test for it. You know, if it does hold here, then that will keep the pressure on the 85 handle if we get a bouncing cable here.
Yeah. No wick yet, unlike this, you know, so nice wick here.
Yeah.
Anyway, okay, that's a difference. So silver's almost at 24. Okay, so this was you know, I wasn't looking at this as being the bottom for a move to 27, 28. So we're getting closer to where, you know, if this is a rally with one more decline to come, should start running out of juice here pretty soon. Gold, I'm figuring, you know, maybe 1930, 1920. It's really been lagging, but maybe we could get up to this moving average here. And I want to talk about the yen. Let's go to Kman.
Yeah.
Good morning, Kman. How are you?
Good. Yourself?
Okay, so are we gonna
145.
145?
That's
Okay,
our magic number.
okay.
If we get a weak PMI, out of the US, I think there's going to be a lot of pressure on the level, especially that we had yesterday that beat in the Japanese CPI, and today, actually, contrary to all the other PMIs, the Japanese PMIs printed a green number. And that is likely keeping, that is for at least for now, underpinning the yen. But I think now we have to wait for confirmation. If the US PMIs disappoint as well, then we're probably going to have a move back into the middle of the ranges in some of the other pairs. But dollar yen, I think, is going to put a lot of pressure on the 145. If in turn it holds, then I think euro dollar and cable are toast.
Okay.
That's mainly what I'm looking at. But yeah, in the end, and I would say it's kind of logic. I'm not positioned in yen as such, but against my option, I'm fully hedged, so I wouldn't mind if it breaks 145, and we see a couple of big figures lower on the dollar yen.
Okay.
Yeah, it's
that could happen. That could happen. I mean, yields are coming off. Well, they were coming off pretty good, but you know, yesterday I said I'd sure have a hard time buying this market. So, you know, we're getting, we had a little pullback there. So, you know what else was interesting? Just, you know, I don't know if it's going to hold forever, but it was certainly a real nice turnaround Tuesday day in the S&P. You see this tag here, this line? It's not the channel line. This is a channel line. This was the throwover line that it got back to when we were talking yesterday. So this 44, 20, 30 level, and you know what? It wasn't even couldn't even get up to 38%.
No, it's still on defensive, right?
Yeah.
I guess if you get a PMI that holds up, despite it being relatively good for the economy, I trust it's going to push the yields higher again, because they can't do anything else right now. When you get a strong US number, and then probably we are going to put pressure again on those prior lows, anywhere between 43.30, 43.60, 43.30. If that goes, I think it's a big deal.
In S&P, it's the low the move we held last week. I agree with you.
Yeah, the issue that we have with yields is that you've got increased US Treasury bond offerings, you've got QT running in the background, and then today we've got that, some call it stupid, 20-year bond offering, and tomorrow 30-year tips. And if we don't see a faltering PMI, I don't see what's going to stop those yields right now, you know. If we get bigger data out of the US, then I reckon the market is going to go to those auctions and give the Treasury what they want. But for now, the bond sharks, I think, are really keeping the pressure on and making the treasury pay up because they have reasons enough to do so. Yeah.
Hey,
Okay.
good morning, guys. Kman,
There you go.
you brought up a great point, you know, as far as yields go and what's happening in the bond market. And you and Ryan were already gone yesterday afternoon. It was, you know, I mean, we're summer. I know, you know, everybody just, you know, tries to spend a little bit less time in front of the computer if you don't have to. And it was kind of like in, you know, in the dead part of the North American session. And I was just saying, man, it sure does feel like a big train wreck right now with what's happening with yields and with what's happening in the bond market just in general. You know, how do you feel this move? And Ryan, love to hear your input here too. How do you guys feel about like the U.S. Bond market with all this supply? It seems like a never-ending amount of supply, and yields continue to rally. What point's the breaking point for like the U.S. economy? What do you guys think?
Well,
Or not even the U.S. economy, but the global economy. I mean, it's not just a U.S. issue. I mean, we're seeing bonds slump everywhere.
and that is what you're saying there is actually the point. It's not only a US problem.
Right.
If it would only be a US problem, I'd say that we are very close to a breaking point, which we probably are. But what is going to stop it? You know, what is going to stop the bond market? Is it a complete blowout? Is it like people throwing in the towel?
Yeah, that's why I feel this way. It's like because exactly what you're saying. It's not just a U.S. issue. Go take a look around the globe, guys. I mean, everybody's focused on the U.S. 10-year, but I mean, it feels like
look
it's
at
like
the gilts, bunds, all of them.
scary. Yeah, it's
They've
scary.
stopped. That's the thing which keeping the dollar bid now as well. Unless the US data really start weakening, it's very hard to stand in front of that train, whether it's in the bond market or even the dollar, you know. But if the US data really start to weaken, then I think the party is over. Then I think we will be acknowledging that the breaking point has been reached, you know, because then the data are going to tell us. And that's what I'm saying. I've been saying for a while now. I think it's less inflation moving the needle than the real data. If the data start to turn, and then I think the party will be over for the yields as well, and the bond market will likely rally, because then all that money that is parked into the money market funds, or which is still in the RRP, is probably going to come out of the woods and go like, okay, you wanna sell bonds, treasury? Well, we'll have them, and we'll have the lot, and we'll buy more. That is going to be the inflection point, in my opinion.
Right,
Yeah,
Ryan,
I'm going to disagree slightly with Cal. I think there is a lot of inflation worry in these moves, and the fact that central banks may have to continue hiking higher than they expect and a lot of people expect. I think it's a fair point, but like everything, it's data dependent. But you know, a lot of the Fed members have been worried. You know, they keep saying the job's not over on inflation. There's still problems. It's not coming down to levels yet that they're happy with or persistent enough. And you know, we got that bounce in inflation the other week, and yields have done nothing but go higher since. I'm not saying Kay's wrong. I'm saying that I think part of it is the inflation picture as well. There's
Dale, I'm gonna snag the charts really quick if you don't mind. Okay.
You know, I was thinking about Powell when he was starting his tightening regime, and I think one of the questions was from a millennial if they should buy a house, and he said I'd wait. And housing prices are higher now than they were when he's embarked on the tightening campaign.
No, I'm pointing out, like, you know, the gilts and boons, and you can see that they've obviously come down because of the PMIs this morning. But for the most part, I mean, just look at the trends on what you're seeing with, you know, yields. This is, you know, globally. I mean, I mean, even Indian 10-year yields are rallying. Well, maybe not China, but yeah, I mean, it is really more a global issue. And Ryan, I agree with you as far as inflation goes. I don't disagree with you there. I think inflation is definitely going to be a lot stickier than people believe. I've been in the camp for a long time that I think this last leg of getting inflation down is going to be tough. And one of the things that I mentioned on the week ahead video, and or was it, did I mention here? You know, we talk so much throughout the course of the week, it's hard to recall exactly where we said what, but I also believe that people are trying to imagine that we live in a world where central banks are going to say, yeah, you know, they're just going to shrug their shoulders and say, well, we're just going to have to live with higher inflation. So, you know, our mandate, instead of 2%, inflation targeting is going to be like 3% now. So I think people are in this belief that that is what the Fed, oh no, we talked about this yesterday, Dale. Now that I'm thinking about it, you know, that people are in that belief that that's what central banks are going to do. They're just going to, you know, shrug their shoulders and say, man, we got to deal with higher inflation. Sorry. So, and I think that people are living in a fantasy land regarding that. I mean, so Ryan, what makes you think that inflation is going to be such an issue moving forward?
Because we haven't had it for donkey's years. You know, there's been no inflation for years. So why do we think this is just going to be a one-off inflation hit and it's not going to persist? Wages, that's your big key point. You know, I'm seeing similar stuff in the US in terms of people going on strike and demanding higher pay, as we have done here in the UK. Look what that did for inflation, or is doing for inflation. So I see the US falling into the same situation as far as wages goes, and that's gonna keep things buoyant. That will keep the soft landing in play. But then you know, it doesn't take much. There will be a breaking point in jobs or whatever, and then we'll see what happens with that. But you go with the flow, as we say, until it changes.
Yeah, I agree with you. It is I think it's going to be sticky. But hey, let's change not the topic, but I want to just take a real quick look at the euro. So and the cable and you know, some of these currencies, and I also want to go talk about equities really quick, because you know, equities, well, I'll come back to that. But look at the euro. The euro's at the 200-day moving average. We have, you know, some channel support down here. Lots of support here. And this is kind of make it or break it. And obviously the euro is coming into support following the, you know, the German PMIs that came in the services sector came in sub 50. Here, if you guys want to see all the data from overnight, you can just kind of take a real quick look. You can see that the German services PMI, we were at 51, slipped to 47.3. That's not good. So obviously the euro's under pressure, but you know, as Kman pointed out, we have the US PMIs coming up. I mean, what should we be thinking here? Because you know, when you see them slipping all over the globe, it's you know, do you think the US is on an island over here? I mean, theoretically we are on the other side of the pond, but you know, what are your guys' thoughts going into PMIs today? Any?
Yeah, that's what I think. I mean, it's going to be a binary event for the dollar. I always show it on the flow show, but a lot of the euro dollar is to be explained with the short-term EU and US differentials, and they are at fresh lows for since really December 2022. So that's keeping the lid on the euro dollar right now. But the US PMIs, I think they have the power to turn it around, and that's what I was saying. I think if the US PMIs come out also weaker, we are going to see a relief rally in the euro dollar, probably cable and stuff like the Aussie dollar, which is starting to be relatively resilient, I must say. But if you get a higher PMI, or even as expected, I would say, then I don't see those EU-US differentials closing any time between now and the whole, at least. It's very interesting because we are below levels, the peak level of June 2022 on the differentials. If you type EU, or I can show it if you want quickly.
Yeah, you can show it real quick. We got 10 minutes, and I do want to talk about Canadian data, and I do want to talk about the S&P. So I'm going to flip it over to you, Kman. And by the way, Mike, you said something about low liquidity. We are in low liquidity, and that's the problem with being in the summertime. And that's why you have to be careful with moves, because when you don't have people on the other side of the move that are like, they stand in front and they're like, I ain't standing in front of that move. That's why you have to worry this time of year. Anyway, go ahead, Kman.
Do you see my
You can ask you a question, Kay, about dollar yen again. Liquidity.
Do you see my screen?
Yeah.
Yeah.
Yeah, you see where the two, that is the differential between EU and 2-year yields. Overlay it with the euro dollar and you will see what I mean. And that now we are getting into, so the lower it goes, the wider the differential, okay, in favor of the dollar.
Yep.
So you can just overlay the euro dollar with this and you will see the correlation. And look where we are. We are just below, because we're just around there, right? The 50% of what's happened from 2022 into 2023, we are on the 50%. We are below this little peak here as well. So it's going to take a weaker US PMI to turn this around, and then your euro dollar is going to turn around as well. That's just what I wanted to show there.
No, that's a great chart. And I mean, and then when you're looking at things like this, not everybody is, you know, these are like, obviously when you're looking at yield differentials, it's not a chart that like the mass market's looking at, but they still respect these major technical levels. And you're pointing out a big high traffic zone that has been pretty big support. So I think it's worth noting for sure.
Yeah, look when we were trading ranges. So this is your somewhere your 96.5 in the euro dollar, right? Went to the lows, and then we went back up to the 112. But I think the 112 was only here or so. But anyway, since we have started to break those lines, I've actually traded on the back of it. You know, it's I'm not going to say it's an easy trade, but it's one that I really keep an eye on all the time. So what were you saying about dollar yen, Ryan?
No, I was just saying, when Blake was saying about the liquidity thing, you could ask your dollar yen question that you did on the flow show this morning.
No, I was just going to show that dollar yen, this is very important, the 145, right? And the 146.5 where we stopped, this is when the US inflation started to turn lower. We had interventions, but this is when the US inflation started to turn lower. That is what caused your big move lower in dollar yen at the time as well. So I think that's why I'm saying data is important now, and not only inflation, because if it were only inflation, then dollar yen would be here. No, it's because your US data are holding up that we are here, and the differentials are there. And because of the Bank of Japan, it's still very slow, although JGB yields are starting to go higher. But look at this level 145. I think it's important enough. If we get a really weak number today, I think we are going lower, 143.
Well, okay, man, I'm gonna take back the charts because I want to show you something just in case we get a strong data. And thank you so much for showing that. And remember, Ryan and Kman are on the flow show every day. Yeah, I'm sleeping. Yeah, so is Dale. We live in North America, so we're sleeping. But if you're in Asia or you're in the Eurozone and you're not listening to these two guys, you need to be, because they will get you prepared for each trading day. Remember to find them, Ryan, if you don't mind putting the link in the chat box, I'd appreciate that.
Yeah,
but if you go right to our website, to ForexAnalytix, you just click on webinars, you'll see a link to the flow show. Check that out. Make sure you guys are listening in to both Ryan and Kman every day. All right. And I want to show you that this is a chart I wanted to bring up, Kman, because you're talking about like if the PMIs come in worse than expected. Well, let's say there's still US exceptionalism, and that's been the theme of the market really for the last several months, right? And you can see it in the dollar, and the dollar is clear in it. If you look at the dollar index, we're breaking out, we're above channel resistance, above the 200-day moving average. Pullbacks have been very shallow, but look at the US dollar Canadian. We got Canadian retail sales coming up. We are above the 618 retracement of this big, high to low, and the dollar Canadian has not backed off. And I feel a little foolish right now because I already took mine off last week, from being long. And I know, Ryan, are you still long this?
I sure am.
Oh man,
wow.
Look at you.
What a patient guy.
You are still riding it, and awesome. But we are above that 618. There's like nothing that says bearish about this. This is a bullish wedge, guys. Just if when you have higher lows and consistent highs. Everybody tries to play a double top, but a double top just builds stops until you break through support. So just always remember that. So right now it's triggering stops above the highs. We have a strong PMI data today, or excuse me, as well, you can say strong PMI data and weak Canadian retail sales, which we're going to see here in about 5 minutes. We'll be trading well above 136. So just keep that in mind. One last thing I wanted to point out before we go into the data, the Canadian data. Notice how the dollar Canadian, notice how the S&P few hours ago, you can see futures were moving higher. And matter of fact, if you look around, just let's go into some, let's go into the German DAX as a good example. You see the German DAX, it was moving higher. PMIs came out, right? And the markets were like, yeah, this is good. Weak data, good. Weak data. Central banks are going to show, their hands. They're going to be, a bunch of wussies, and they're going to start cutting rates sooner rather than later with all this weak data. But I don't agree with that. I'm in the camp that central banks need a lot more convincing about inflation to start, even getting into the realm of cutting rates. I think this is going to end up being a growth story. And so if you watch the S&P price action today and the US equity markets, if we have weak PMIs, you might see an initial knee-jerk reaction that stocks strengthen, but I think you have to sell strength if that is the case. So
100%.
Yeah,
100%. That's what I mean by watch the data.
Yeah, I think the data is going to be really important, but you can't do what is Pavlovian right now in the market. Weak data, that's going to be good for the market. Screw that. Weak data is bad for growth, and you're going to see stocks get punished. So if stocks rally following a weak PMI print, you need to be selling rallies today. And that would be my opinion. Now, obviously, the other way around, if we get strong data, I mean, maybe stocks catch a bid and stop sliding. That could very well happen too. But just something I want you guys to think about. Now, we got just a couple minutes into data, and also keep in mind, NVIDIA reports today after the close. Remember the AI company, NVIDIA? I'm joking, guys. I'm being very sarcastic right now. But look at this price action yesterday. Look at that double top nearing the 161% extension in NVIDIA. It gapped up at highs, and it sold off aggressively, Dale. And pre-market we're down a little bit too. So it's ugly.
Yeah.
Yeah. Right.
But, the ugliest thing is the banks, Blake. I mean, how can you have a bull market in stocks and a bear market in financials?
I'm going to go park my money in crypto. Oh, wait a second. No, I'm not. Just kidding.
That's really, I think,
just joking. There's Bitcoin. There's Bitcoin approaching 25,000. The big pivot. Okay. Let's go into. I'm going to pull up the dollar Canadian. Real quick, Ryan. What are you looking at today? What's on your radar today? We got just 2 minutes.
I might look at this dollar CAD number. If it's good retail sales, it's probably going to get washed out pretty quickly, but that might give a little dip in dollar CAD to get on this break again.
Okay, very good. Kman, what's on your radar today? I know you mentioned dollar yen at 145. Is that the big one for you?
I think so, yeah. Weak PMI, that could be putting a lot of pressure on that level. I think it's a very interesting one to watch. And then good PMI, I think euro, dollar, and cable are going to get hit.
Yeah, and this is the 140, just so you guys can all see it for those of you that don't follow it. Here's 145, 145, and where we're at 145, just to give you guys some clarity on the dollar yen and why it's so big. So good eye there, Kman. I'm going to pull up the dollar CAD, and Dale, we have less than a minute. You looking at banks today, or you have anything else?
I just think that yesterday's highs in the S&Ps were key sell rips. Wrong
sell
over
rips,
yesterday's highs. Yeah,
sell rips and don't buy dips.
Yesterday. No, don't buy dips. Not till 4,200. 4,200, you could take a stab at the long side.
Very good. All right, we have about 40 seconds to data flash, so that's going to give me an opportunity to say thank you all for hanging out with us. We have a very big group here on a summer day. in the middle of August. So for those of you that are here, make sure you check out our chat rooms and ForexAnalytix and the platform. If you get involved and you take your $1 trial for ForexAnalytix, download the mobile app too, so you can have all these chat rooms and all of us at your fingertips and see all the different charts and jump in the, see what we're all about, all the different tools that we have on ForexAnalytix too.
Yeah, the phone
like
app, the phone app. So you could be out living your life and push alerts will let you know if there's anything important happening.
That's right. Canadian retail sales, a little worse than expected on the month-over-month number, and the actual number a little weaker than expected as well. So on the core number. So yeah, you can see the dollar CAD is reaching higher. So keep an eye on the dollar CAD, especially if we have strong PMIs. Now, I know we've been focused on weaker PMIs today, which I think is a risk too, like, we've been talking about. But in case it's stronger, this dollar Canadian can come out of its shoes if that's the case. I mean, how many people have been trying to short this bad boy for the last month and just getting walked all over by Ryan Littlestone?
Hey, there's enough room on this path.
Anyway, hey, Dale, I hope you have a great interview. Ryan, Kman, you guys are superstars. Thanks for getting us all prepared for the trading day every day. And I'm going to pass it over to you, Dale. Have a great interview.
Hey, buddy.
All right.
Thanks, team. Thank you, Blake. Thank you, Blake. Kman, Ryan.
Thanks, mate.
Good stuff. Like always. Thank you, guys. Daniel Hussey Jr. How are you?
How's it going, Dale?
Good. Welcome back.
Thank you. Thanks for having me back on.
Oh, it's great to have you. Top of mind for you, Daniel. What are you thinking?
Well, why don't we start with the S&P here today? But we're also, in the midst of crop tour here. So a big week for row crops, corn and beans, going to be looking out for that pro farmer number, giving us some insight onto the in-field data as to how the crop is coming along. But I heard you mention there that S&P, don't be a buyer till around 4,200. Man, you're like taking words out of my mouth here. I can't disagree with that sentiment. I'll throw up some charts here, but let's begin with that S&P.
It's interesting now. I have an interest in the grains, and I've been waiting for the wheat to come out of here for a while, and the beans still seem to have the most constructive technical pattern. And isn't it true, Daniel, that the bean crop is made in August? So
it is.
Okay.
It is. And rain makes grain, right? And I actually have prepared here a couple of weather forecasts that we can look at. What the heck? Why don't we start here since we're on the topic anyway? 6 to 10 days out, look at that big below average rain forecast for the Midwest. That to me suggests, rain makes grain. Well, the lack of rain means if beans are made in August and there's no rain in August, well, the pretty good bean counts, in other words, pod counts, the field analysts out on the crop tour right now are going around field by field and taking data assessments and literally counting the number of pods on each plant. Well, the plants look pretty good from the road. They had a good recovery here over the last several weeks. We got some good rain into the end of July there to kind of save us and pull us out of what was otherwise very big drought conditions. But you can see over the next 2 weeks, there's really no hope for rain in the forecast for anywhere from Texas up to Canada and through the Great Lakes region here. That, coupled with, what are going to be basically above average temperatures as well for August, the dog days of summer are here. And, soybeans might have a struggle to make a crop here. Like you mentioned, I agree. Soybeans are the most constructive out of our row crops. The new crop contract, which is the chart we're looking at, the Novi here, we're above all of our major key moving averages. And actually today's lows that we held in the overnight session, which is really indicative of, in my opinion, a trader in the Asian session, being a buyer in soybeans. There's been this overnight bid that we've been watching. And to me, that suggests that our big trading partner, China, might be in here, trading futures and utilizing the board alongside other means to get their fill, so to speak, of demand. But we're above that 18-day moving average, which for many commodity traders, we use as kind of a short-term day trend indicator while we're above or below. It's a good, indicator of where that daily trend is heading. Breaking back above that 18-day, above that 200-day, above that 55-day, and holding them all again here as support is pretty constructive just from a, reversion to the mean moving average standpoint. Then
could I
as
ask
we,
could I ask about the corn, which has really been the dog, but I see divergences developing at these lows, almost a 3 drive to a bottom formation. Could that be the sleeper?
it could be.
Okay.
And the crop tour right now, I think, is what corn is really waiting for, to see those yield numbers below what the USDA has been telling us throughout this year. We use the USDA's balance sheet, or what the USDA tells us, as a benchmark for where we think the end of the year production will be. And for those not familiar with the crop cycle and row crops, they come off of the field once a year in North America. So that means all of the grain that we have for the next year will be made in November, or will be harvested in October through December. And there won't be any more grain or supply, if you will, until the following year. So that means all we have is demand. Carryovers are tight for soybeans, but for corn, we're a little bit heavy on that carryover. Carryover in soybeans is going to be near what we refer to as pipeline if we don't get, a good yield this year. Pipeline is the amount of demand we need, a number that we have to hit so that we don't literally run out of soybeans on hand. And we're down to about 200 to 300 million bushels on hand soybeans year over year, which represents, a 20% stock to usage ratio. In other words, we only have about 20% of our yearly usage on hand, which is very, very tight.
Yeah.
When you consider markets like wheat usually have 40 or 50% of that usage. And I'm sorry, that stock to usage ratio is shrunk down now in soybeans down to less than 5%, excuse me. We normally have around 20%, right?
Okay.
Anyway, if the USDA number for soybeans comes in below 52 bushels an acre, which right now that crop tour is out there trying to figure out what that yield could be, we are, run the risk of, so long as demand for soybeans remains strong, we run the risk of proverbially running out still, which is why beans are still in the teens at $13, while corn has fallen below 5 again here. Because when we look at the corn crop, we got key rains right at the time when we needed them in July. We were able to get through pollination, but the corn did struggle. And now that we're getting heat into the end of that maturation cycle for corn, in other words, the crop has been made. Now it's a matter of how well can it finish. It's not finishing well. And what we're seeing in the crop tour,
it's not how you start the race, it's how you finish.
Absolutely. And what we're seeing in the crop tour, the initial numbers coming back, is in places like Ohio and in South Dakota, where we witnessed good rain and a decent growing year, they have pretty good yields. But now as we're getting into some of those problem areas, eastern or western Indiana, Illinois, eastern Iowa, North Dakota, Kansas, no Kansas on this tour, but Nebraska, we're seeing those yield numbers drop significantly. And that means we might not have as much supply as the USDA was originally telling us. And if that's the case, corn showing that divergence down here.
Yeah, that's a nice formation.
Right. Yeah. And we already know that corn has the ability to rally all the way back to 560 or even 620. It was there just a couple months ago, during the summer months, during weather markets for corn, when we had a very dry and warm June. Then we got rains in July, which drove prices all the way back down to $5.
I'd even buy a bearish report. Say they sold them off one more time. I'd step in front of that. Probably with calls, but
and we're down. We're down towards historically lower levels for corn. Right, we're back going down.
To me, it doesn't seem historically low. I used to trade them when they were $2.
And I guess I misspoke. What I mean is we're going back down into the old historic range lows.
Back to the old highs, historic range highs.
We didn't quite have the blow off tops that we had back in 2012 when we had a real crop loss and summer months that were in the triple digits. We're going to see a little bit of that over this next week, but not enough to drive us to $8 corn. But have we sold off now in this, what has otherwise been a very inflationary market across the board?
We're at a fib level here, Daniel.
I would say we are, and that's and soybeans too. Both corn and soybeans have pulled back into big, basically 50% fibs of their major run-ups since the 2020 COVID lows, where just everything made a major bottom to some extent, right? And then we went into that post-COVID inflationary cycle. Looking back on it, it's kind of you look back on that 2020 through 2023 timeframe, and I wonder why it wasn't so easy just to buy everything and close your eyes because of how much money printing and debt was being introduced to the market. It was a weird time where we saw an expansion, right, in monetary policy on an unprecedented level. And now we've seen, I think, the first burst of that inflation. Well, central banks around the world obviously have all responded over this last year. And I think in the broader commodity cycle, we're also seeing, right, that bit of a pullback. We haven't necessarily seen the slowdown, I think, in the stock market people were expecting when interest rates rallied as they did, but certainly commodities took a halt, and there was a wet blanket thrown on many markets. The wheat being a great example.
Yeah, what's holding it back is Australia having another good weather year. I've talked to grain people, and they keep getting lucky with rain, and that's what's keeping supply adequate.
That is right. They're keeping supplies adequate. We're also seeing state entities, like, for example, the Indian version of their USDA is actually dumping state stockpiles on, and this is the country of India, is dumping state stockpiles on their domestic market to try to suppress wheat prices. They've also imposed a 40% export tax on wheat. So India is no longer an exporter of wheat on the global economy, but they're also, right, there's this notion that other countries like China might be doing the same thing. So that's keeping, a dampening, or keeping a dampener on major players or buyers, the big countries buying wheat right now. Plus you've got a good crop in Australia, and you've still got grain that's been making its way out of the Black Sea region. The Ukraine-Russian crisis was not as big of a hiccup to the grain markets as I think many people anticipated. And the whole run up in wheat above $8 was on the back of, right, the Ukrainian or Russian invasion of Ukraine. And then as those news headlines started to kind of get stale, we started to see a grain deal and grain make its way out of the region that we were otherwise basically pricing out of the global market there. If you took Russian and Ukrainian wheat out of the global market or out of the global market for wheat, that's how you get to $12 and $13 again, right? The market pulling back, I mean, deflating, so to speak, that inflationary run up on a wartime news headline.
Looks like oil.
Yeah, it does, right? And most of our commodities, to some extent, have this same kind of look and feel to them right now, which I believe creates longer term opportunity. But it also means that I think when you look at just the short-term ranges, for example, in wheat since June, I mean, we've got a dollar wide, $1.50 wide range that we've traded, and at times only taken a couple days to trade up and down inside of. That's pretty volatile. Some big money is being thrown around in commodities still. And I think, that volatility can create opportunity, but also creates immense risk. But like you said, options are a beautiful way of managing that risk, particularly in commodities and very volatile assets, where you can buy a put or a call, know exactly how much is exposed in terms of risk appetite, whatever you paid for it, and you give yourself all the upside of owning the underlying if it goes in the money. So it can be very beneficial for the trader for sure.
Okay, Patrick's asking about sugar. Do you have a view?
Let me see if I got sugar. I have rice and cotton that I cover a little bit closer. I'm actually looking for both of rice and cotton, and I will get to sugar here in a second, to continue these otherwise uptrends that we've been forming. Cotton trying to get back above that 18-day moving average. I think we're just could start, basing above 83. When you take a step back on cotton, we've got a big breakout. I think that could happen here. Let's take up, let me pull up a sugar chart real quick and take a quick look at it. We've had a pretty volatile year for sugar and one heck of a run. Last time I really looked at the October sugar chart, that's right. It's consolidating here, right? Sugar goes into these, maybe $4 ranges in terms of a very larger, broader trend. Watch that 18-day moving average in sugar. It tends to be a very good daily indicator. Once we break below it, you can see how we went into that sideways chop now. And I think that $4 range in sugar from 26 to 22, reversion to the means right back into the middle of it. This is a textbook wedge of, folks forming in the sugar. So watch that trend line against the highs above 25, probably a breakout. Take a box, right? The distance of this range, $4 above 26, probably 30 towards an upside target with, if we continue this trend higher that sugar's been in of moving $4 to $10, ranging $4, and then, continuing on that we've otherwise seen since, 2019, 2020 lows. Probably one of the best commodity run-ups that we've seen, and one that has held on to its gains from 2020.
Yeah,
right. This is one of the few that has not given back 50-60% of that whole run-up. You look at everything, even lumber, which I don't know why lumber's not coming up on this chart for me, but lumber was a great example. It was one of the first markets that ran up to 1600 board length and then fell all the way back down to 600, right? Orange juice also in the midst of a run up right now. There is weather concerns in Florida and in Brazil and other growing regions. Pretty much nowhere that grows orange juice is doing well. In California, Florida, and in Brazil. So it's the demand for orange juice is still strong. This is a market where there's a lot of a lot of speculation. So and not much liquidity. So these run-ups can get very volatile, and so be very cautious. Reversal here is probably.
If you don't believe what Daniel's saying, watch Trading Places, and you'll see how there could be big reversals in the OJ market.
Yeah, and that's one of our favorite, kind of go-to laughabouts in our industry in commodities tradings is that movie and that scene where the OJ market has a USDA report being announced, and I feel that way with USDA reports in the grains. We're always the last to know on these big news events, but they're so critical to the market and price discovery that they're hard to ignore. So, but soybeans being the most constructive. Okay. When you mentioned, the big 50% pullback, basically that November beans are effectively in from, their swing lows from the 2020 timeframe. And this is a chart right now, a daily chart of just the November beans. So this isn't a continuation chart, but you can see that even when we were liquid and down there, it's still a pretty good 50% pullback. The continuation chart looks just as well. Now there's another 50% pullback right from this 1128 low to high. Let me flip over to that 4-hour chart so we can look at that in a little more detail, because I think we're building into this nesting against now a couple trend lines and building into these 50% ready for a breakout. And this next 2-week period for soybeans is going to make or break this idea. I don't discount, or I can't totally take out the idea that we flush one more time to the downside. There's a lot of room in this chart all the way down to, the old lows there from May for soybeans to be able to pull back and still be in a bigger range, because price discovery in row crops this time of year is very contingent on the supply and demand, conversation. How much are we making? Because we know generally how much demand there is. China always buys about the same much of soybeans. Mexico always buys about the same much corn. We know how much the ethanol and soybean crush industries use for both. We know how much the livestock industry uses for all of it, generally speaking, with some increase year over year. So we can, work out balance sheet wise how much is going to be left over. But over the next 2 weeks, you don't get rain. We get that heat. Beans are made in August, like you said. There's no rain. We don't make rain. This chart could get very bullish very quickly. And particularly if we see now in the remainder of the tour this week, now that we're getting into Illinois and the problem spots in Iowa and Nebraska, if we don't see those pod counts, near their 3-year averages, they're much lower. If there aren't pods on the plant, it won't fill out the pod. So you're just naturally, you can cap out on yield based off of what, if you don't have a good pod count right now. So there's a lot of good information coming out over the next week on the fundamental side that can help shore up any questions we have about those balance sheets. But I'll tell you, the technical picture for soybeans right now looks really, really bullish to me. 1130 swing low to high here, pulled back almost to the tick, 1282.75, 50% pullback. That then gave us kind of these two trend line supports that I was watching, and one of them has proven itself time and time again. We have now rallied up over the last week up to fill an open gap at 1331. The market then rallied. It continued that rally after breaking out of this kind of sideways consolidation and wedge. We went above, this multi-day
back to
range
the
highs.
breakout last night.
Exactly that. And by the way, a 50% level from that 1282 swing low to that 1381 high. It was almost to the tick, 1331 and 3/4, 1332 and a half. What's a half a penny among friends there, into that level. So very technical level. We got now a pretty substantial rally, 10 cents off that low for the day. And this is a 4-hour chart. We only have a couple more hours to go in today's session, but you can see how this could very well turn into a reversal. We go above trend lines as we start to go down to and before we do, I want to point out we had an open gap on this chart. This decline was so steep and the sell-off was so nasty 2 weeks in a row. Basically on Sunday nights, we opened lower and left these gaps open. Well, we came right on up and filled both those gaps, and we hit the 618 line of that full decline. So that to me says, hey, 50% shorts where you'd expect, sellers to, put up their fight. They're unable to do so. And they're, giving up 61% of their last move. Whereas the longs, they're only giving up 50% of each pullback. So we're starting to see that building of progress, in my opinion, to the upside. We still got to break out. Right. And if we get rain over the next week, this could all roll over just because of pure fundamentals. Funds can come in and smash this market lower, as producers will also run in to hedge their crop, because now all of a sudden a farmer who only thought he was going to maybe have 100,000 bushels of beans might have 125,000 bushels if he gets a rain, might have 150,000. That's the difference here in people's production numbers. And if you take that 150,000, right, or just the 100,000 for easy math, right? That 100,000 bushels of beans times $13.41 a bushel, that's a $1.3 million crop here. So we're talking, big bucks swinging around for farmers. Coffee and cotton. I saw a question come in there. Yeah, let me quickly wrap.
From Richard.
Absolutely. I'll have more to say on cotton and the coffee.
You showed cotton. You showed cotton.
Yeah, and I'll come back to that and give a little more detail because I do have that. But lastly, here for the soybeans, watching on the short time frame, because hey, I'm actively working with clients about trying to build into long positions here, using some of these levels as stops. Of course, you're working with options right now. Buying $14 calls, selling $15 calls against it to give ourselves a reopening to the upside, because a lot of my traders are farmers, and they may have already sold their crop at the elevator for a future delivery. Well, they can come in and use options to reopen that upside right now on these dips if they want to, and that's part of the strategies we're working with. But the downwards, sloping trend line against the highs here, watching that closely here. It also kind of aligns with highs of the day around 1350. That would give us, one of an intraday reversal kind of setup, in my opinion, happening off of what is otherwise a 50% long. So we'll see. Let's move on to cotton here for you, and then we can take a look at coffee. Cotton, I got more to say. I've been tracking cotton for this range for months now. In the cotton, expecting it to go higher, right? We've been watching triple-digit heat down in Texas in the Panhandle region. Georgia and the southeastern states have made, I think, a pretty good crop. I think demand is still there for cotton. I'm not a huge believer that we're going to see a major recession in front of us. I think we might see slowdowns and this and that, but there's just so much money out there in the system. It's hard to have a real slowdown when there's that much, when we have printed that much and put that much M2 out there. I think we saw it with.
Then what's wrong with the banks, Daniel?
So what is wrong with the banks? You mean the actual financials, right? They have been sluggish. That could be a sign that there's another couple banks to fold, but I think we're going to continue to see, just like we saw with the bank failures over this last year, very big banks will come in and gobble them up overnight. The FDIC will flip things and turn things around.
The XLF is breaking down too, so there goes that narrative.
Sure. And there's definitely there's definitely reasons to be concerned, but I think bull markets also climb a wall of worry. Now, that doesn't mean I think we go out and you buy stocks today or few stock futures for that matter. I think, you're right. There's a pullback happening, right? And I think there's reason to think that these slowdowns will happen. Markets will pull back. Longs will take profit. Are we going to go into a major recession?
Take a look at Citi Bank.
Sure.
Take a look at Citi.
Yeah.
Tell me what's bullish about that, and then take a look at it's worse than the regionals.
Sure.
So it's not just the regionals; it's the money center.
Yeah,
and Daniel, what about the bonds?
Names, so.
How about the bonds, Daniel?
Sure.
I mean, aren't there some things to worry about that it could be more than a correction? Because I'm glad people are saying this is only a correction.
Yeah,
I don't want company.
Yeah. So I think this downward sloping trend line, and otherwise the downtrend in the bonds, right? This is the 30-year bond futures. This represents, for those that don't know, flip it upside down, and it's basically a chart of the 30-year yield. So the higher you go on this chart, the lower the interest rate's going. The lower you go on this chart, the higher the interest rate's going. So we're pricing in right now, and people are still looking for the Fed to continue to with their monetary policy of rate hiking. And I don't disagree. I don't think the Fed has done enough. I think we needed a Volcker style, and Paul Volcker, who I'm referencing here, a Fed chair that, had the biggest, I think, interest rate hikes on history, some of them being surprise rate hikes of multiple percentage points. And that was a way of, throwing a wet blanket on inflation. Our Fed has not done that. They've really eased into this, trying the soft landing narrative. There's always volatility. There's going to be hiccups along the way. But I think we are, when you look at commodity spectrum as a whole, I think we're bottoming on that inflation trade. The stock market has made some considerable progress over the last several months that a lot of people didn't think it was going to do.
True.
And I think we need to acknowledge that we're still pulling back now to test levels we just broke out of. Let's see what it does when it tests those old levels, right? Just like here, let's see what it does when we get down to the 2022 lows for the bonds as well, right? If we bounce from here in the 117, 118 handle, we're just in a 134 to 118 range. That to me just says price discovery, and now the market is very content with where we are in the market. We were, I thought, channeling maybe a little higher here. We then obviously found our resistance there, the old support, now resistance, rolled over, broke. What did I just do?
That's okay.
Oh, turned on demand. Okay, broke below that trend line support, right? And then you can see my trend line against the highs there, which I don't know why I removed that one and didn't remove that. But nevertheless, we're right back down to the lows. We continue lower through these lows. You really got to go out there on the 30-year. In fact, I need to pull up like a monthly chart at this point to see. There we go. We're going back now, right, to some really, really, old levels. And granted, where we came in 2020, that was, quite a considerable swing low, so to speak, I think, for bonds. Yeah. I think the Fed now has given itself a lot of room on this chart, if they need to, create, easing policy, there's a lot of room now for them to do it. There's a lot of room to the upside for the bonds to move, so to speak, if they start, wanting to devalue the currency, buy back bonds, do another POMOs, do quantitative easing like we saw in 2008. Every point this chart falls, in my opinion, is just more ammunition for the Fed for the next, real crisis for them to use.
Okay. And quick look at the dollar that's been relentless.
Yeah, really, really relentless. A quick look via the Euro futures this morning, coming down into that full 50% kind of this last swing up. Been a very, very choppy rally for the Euro currency. And you could say the same for the dollar, the Dixie in general as well. We're starting to break above, and I'll look at the continuation chart here. Daily nearest usually works best. There we go. We're starting to break above a trendline resistance after breaking out above this 200-day moving average. This is a pretty significant, reversal or show of strength for the dollar. We need to see momentum continue. Yes, up. And watch this 18-day moving average for the short term, trend higher. We reverse this, and this becomes a 1 or 2 day fake out higher. We get back below these levels. When you take a bigger step back, you have to realize the significance of this 102 to 105 area on the bigger time frame, because the dollar really does go into these multi-year, at least when you look at the chart of the Dixie going back to 2000, goes into these multi-year ranges where you have major support and resistances that stick around for this platform here is called commodity. It's by bar chart.
Okay, you
it's
want
what I
to
get
give
most.
you want to give quick coffee opinion for
Sure.
Richard, and then we'll wrap it, Dan.
Yeah. So anyway, just to finish the dollar here, right? We are coming down to test old resistance as support. This could be a show of reversal for a swing higher and setting into this new range above 105 to 115. If not, we fall back lower below 100. We're back to this old range. It gets pretty bearish. Yeah. Let me throw a quick coffee chart up here.
Is it decaf or?
Yeah, so September coffee, looks a lot like cotton in a sense that of this daily range that we've been in over the last several months. Yeah, and kind of pulled back against a much larger low. We have a double bottom in coffee, and I think this key reversal that we have going on today. In other words, we had this inside price action for a couple days, and then now pushing higher above 3 days. Look for resistance up around that 18-day moving average of 156, but you break above there, you open yourself up for reversion to the mean here, back to the middle of this range, back to the 200-day and 100-day moving average around 171. And yeah, you're just coming off of a double bottom. We've been all the way up to 200. So there's probably a bigger range here for coffee, so long as we stay above this low. We're out of daily oversold conditions. This chart looks like it's, not saying I'm super bullish coffee, but if I was short, I'd think about taking profits and looking to resell a little higher. If I was long, So we'll see.
Eye.
Yep.
Yeah, we have some good traders in here. Okay, so Daniel, best way, this is how you reach Daniel. He's out of Chicago.
That's right.
Twitter. Okay.
You can always find me on Twitter, on what's it called? On Facebook. Let me bring that back.
You mean X?
Here.
Yeah,
X. Yeah, you're right. I'm never going to get used to that. There's my information, 312-277-0110. Just give me a call. You can find me on Twitter, Facebook, shoot me an email. Throw in a link in here. You can also feel free to sign up at I'll figure out how to get it in there, but you can sign up for our daily call-in. If you ever want to hear from us, it's totally free. Our chief market strategist, Ted Seifert, gives our daily opinions on all of these markets. But all of that and above, love to talk to anyone about commodities and futures trading if you have any interest in it. Dale, thanks as always for having me, and it's been a complete pleasure.
Yeah, it's kind of a rare thing nowadays. I used to do what Daniel did as having my own IB or being a commodity broker, but to have a full service guy like Daniel Hussey Jr. For your commodity trades and everything else, kind of the last of a dying breed. So they're not easy to find. So
yeah, it's always a pleasure working with clients and helping manage risk and create trade plans with people, right? That's you're the captain of the ship. We're your first mate and navigator. There's a reason, right? We're here for you.
Yeah, full service, discount commissions.
Everything in between.
All right, Daniel. Thank you very much for being here, my trading warrior brother, and have a great rest of the summer and fall, and we'll catch you later on in the year. See how things played out. See if the beans get to the 20s.
Yeah, we got to get to 16 first, but I would look out over this next couple of weeks. People look out for that rally to continue, probably form some kind of harvest top. Then into and through March of next year, I don't think that's out of the question. They're already paying $20 a bushel in China. So,
yeah.
All right, have a great day, everybody. Thanks a lot for having me.
They'll buy it all. All right, thank you, Daniel. Adios.
Take care.
All right, everyone. Thank you very much. Don't just count your pips, count your blessing. Richard liked your analysis, and thanks for taking questions. And you could join the team in 12 minutes on the Morning Edge. See everyone tomorrow. Adios. Thanks, Daniel.